What's happening now with the UK property market is causing so much damage, and I witnessed this firsthand as the founder of the British Home Group. Since 2013, my nationwide estate agency, British Homesellers, has managed thousands of transactions worth over £5 billion of property sales. So I've had a front row seat, in a way, of how the market has shifted and changed over the last sort of 12, 13 years. And my goodness, are things really quite fragile right now. You know, if you're a homeowner or hoping to be one, or renting and stuck thinking you'll never own a property, this video I've made for you, because over 2025 we've seen 10-year gilts rise almost 10%. That's government debt. Stamp duty has increased. Smaller landlords have been exiting the market at mass, and corporate landlords are stepping in to replace them. The result? Debt is expensive, buying is expensive, renting is expensive, and billion-pound corporate entities are mopping up not just property, but all sorts of UK assets, global assets. What we're seeing happen is more than just house prices rising and falling. We're seeing the property market system evolving, being tinkered with, and today I'm talking you through 4 key things that are dramatically changing the UK property market, and why it's very possible the next decade of the property market will look nothing like the last 10, 20, 30 years of property. Let's start with the illusion of price stability. Over the last few years, on the surface, property prices seem stable. That's what the headlines show us. Average house prices nationally have flatlined. They've grown 2.7% over 3 years, but that is an illusion, because house prices adjusted for inflation have actually dropped 5.2% over the last 3 years. In fact, since the peak end of 2021, house prices adjusted for inflation have dropped 17.5%. Just to put that into perspective, in the 07-08 house price crash, prices dropped 20% back then adjusted for inflation. Since December 2021, house prices have dropped 17.5% adjusted for inflation. Yet most of us probably haven't realised we've seen a house price crash almost as severe as we saw in the 07-08 crash. And things could potentially get worse, because look, house prices haven't dropped when you don't adjust for inflation. Inflation is hiding the reality, it's skewing the reality for us all. But even the severity of inflation isn't directly clear. The Bank of England focuses on getting the inflation rate down to 2% target, but this only looks at CPI, the Consumer Price Index, which doesn't include housing costs. You have to look at the CPIH rate, which is CPI, that includes OHH, owner occupies housing costs. The two combined give you a clearer understanding of the real inflation we're all experiencing. As you can see from this graph, CPI runs at 3.8%, CPIH, which includes housing, is running higher at 4.1%. If you separate the two out, CPI is running at 3.8%. Owner-occupiers' housing costs is at 5.3%. CPIH, which combines the two, is what produces that 4.1%. So I hope this shows that inflation is a far bigger issue than most realise, because the RPI figure the Bank of England is trying to control to 2% is a complete underrepresentation of the day-to-day inflation we all feel in reality. For most of us, housing costs are our biggest expense, so why isn't owner-occupiers' housing costs inflation managed as closely as CPI? You tell me. Now let's talk about the supply shock and regional divergences, because right now the upcoming budget has created massive uncertainty. We all know that. It's a bit of a nightmare. As a result, the flow of new property coming to the market has dropped slightly. The buyer demand is up a little, but the overall stock of property on the market is 8% higher than this time last year, compared to the volume of sales agreed being up just 1% against last year. If you compare this to the same data shared just 3 months earlier, you could see the direction of travel was far healthier on the demand side back then. But let's put them both side by side. It is quite clear the challenge has been a bloating of supply of property on the market, although that appears to be slowing down now. In short, if you look at this, there is more property entering the market for sale overall than there has been buyers buying them. But of course, up until now, I've been talking about UK average prices and metrics. In reality, for the last 30 years, we've been seeing an evolution of two halves of the property market. The left map shows average house prices in 1997. The lighter the colour, the lower the earnings to house price ratio. Just take a look at how things have changed in the right map of the UK. Yes, house prices as a multiple of earnings have increased across the board, but far more across the south than the north. There's a bigger and bigger division between the two areas. You can see here that right now the annual price changes are experiencing quite dramatic differences across those two regions. The north is really pulling up the average figure, while the south is struggling. All the house price growth is really coming from up north. But it's also worth noting the differences in house price growth by property type. Flats are generally suffering across the UK, but there's another worrying trend we need to talk about: the ownership shift from individuals to institutions. This is where the real challenge lies ahead of us. Historically, UK housing ownership was deeply personal, families owning bricks and mortar. Yes, the buy-to-let market boomed, but much of that market is made up of small buy-to-let landlords. Even the bigger ones are tiny when you compare it to the big corporates muscling their way into the market. That model of the past is now being hollowed out, replaced by institutional ownership. The likes of BlackRock, Legal General, Lloyds pension funds. They're not small landlords, they're empire builders. Entire blocks purchased off plan before you see them. Assets held for yield, not habitation. The build to rent market is exploding. 1 in 5 new builds is a build to rent unit. Look, I get why the government are leaning on big corporates. They need to encourage billions of pounds to flow towards UK property construction to hit their targets. They want to deliver these 1.5 million homes. They're assuming bigger corporates will increase standards compared to the fragmented buy-to-let market of smaller landlords. If you need more coffee shops on your high street, for instance, you can encourage smaller firms, entrepreneurs to innovate and build coffee shops in their local communities. Or you could call Starbucks or Costa or Greggs up and support them to do the same at scale. If you want a quick, fast solution, what route would you take? You'd call Starbucks up or Greggs up. But if you want the route that spreads opportunity in the community, spreads ownership of assets in the community, different coffee shops owned by different people, you encourage the day-to-day local businesses to flourish, that hire locally, that pay taxes locally, that spend locally. The consequence of government taking the corporate shortcut is we're selling more and more control of the UK property market to big corporates, to big companies, many of which are owned overseas. Let's talk about something else that hurts the small guys but helps the big guys: stealth taxes and fiscal drag. We've barely talked about a crucial hidden force that inflation is maximising the negative effects of, and that, my friends, is stealth tax. Freezing income tax thresholds, stamp duty bans, capital gains allowances, all of these quietly raise the tax burden while the government sits there and denies rate rising. Since 2021, thresholds haven't changed, yet inflation has been huge. The OBR estimates that by 2028, this freeze will bring an extra £44.6 billion a year, which equates to £1,400 more per household. This stealth tax isn't accidental, it's a way to, in reality, raise taxes whilst claiming you're not. It's completely misleading. Let's talk about what we have in store over the next decade. What changes are permanent? So what does this all add up to in reality? Inflation makes those with no or little assets poorer because it devalues paper money, fiat money, and pushes people to store wealth in anything that feels solid. So property, land, gold, even Bitcoin. But here's the uncomfortable truth of all of this. When assets become the hedge against inflation, ownership consolidates. The people and institutions with the deepest pockets end up owning more, not because they're smarter, but because they can wait. They can hold these assets through downturns. They can refinance when rates rise. They can buy when everyone else is forced to sell when prices drop. That's why decade after decade, ownership is drifting away from individuals and towards corporations, pension funds and the like. We're entering the rentier decade, the rentier century, a Britain where more people rent for life, where property acts more like an income producing utility than a personal asset or home, and where home ownership, once the backbone of the middle class, becomes a privilege, not the norm. Now, this isn't some dystopian prediction, it's what the data is already showing us is happening. Home ownership among 24 to 34-year-olds peaked at 2003 at around 59%. Today, it's under 38%. Meanwhile, institutional landlords' share of the rental market has almost quadrupled in a decade, and it's still growing exponentially. So what happens next if mortgage rates stay around 45% and wages continue lagging inflation? House prices in real terms will likely remain flat or even decline slightly. But that doesn't mean property will feel cheaper, because borrowing will still be expensive and taxes will stay frozen. The real winners over the next decade will be: one, those who adapt their strategy, whether that means downsizing, diversifying into different regions, or using limited company structures to offset tax if you're a buy-to-let landlord. Two, those who understand policy, knowing what's being legislated for months before the headlines give you clues, which is the advantage big corporates have. Three, and those who think generationally will have an advantage, because it isn't just about timing the market, it's about surviving the transition into a new model of ownership. So it just encourages more and more people to amass wealth to pass on down the generations. What we're watching isn't a blip, it's a full-scale re-engineering of the UK housing market from a nation of owners to a nation of tenants, and whether that future is good or bad depends entirely on who ends up holding the keys. If you found this useful, hit like, subscribe and share this video, because the only way to protect yourself in a system like this is to understand it. Thanks for watching, and I'll see you in the next one up here.